Okay, let's continue on with the third part of our discussion of preconditions for an audit and the auditor's responsibilities. And so the first few, we established what a precondition for an audit is, and that includes that the client has an appropriate financial reporting framework, and we discussed that in the last video. But in this video, let's discuss the premise of the audit, and that the auditor is supposed to obtain an agreement of management that acknowledges and understands its responsibilities under this premise. And so management's responsibilities are for the preparation and fair presentation of financial statements in accordance with applicable financial reporting framework. Management's also responsible for the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of financial statements that are free from material misstatement, whether due to error or fraud. And management's final responsibility is to provide the auditor with access to all information of which management is aware that is relevant to the preparation and fair presentation of financial statements, such as records, documents, and other matters. Management also should provide the auditor with additional information that the auditor may request from management for the purpose of the audit. And management must also provide the auditor unrestricted access to persons within the entity from whom the auditor determines it necessary to obtain audit evidence. Now, all of this will generally be included in the engagement letter or the contract that the auditor has with his client. And so that serves as a basis for management acknowledging that it understands its responsibilities. So let's go to each of these in part for the preparation and fair presentation of the financial statements and for the design, implementation, and maintenance of internal control. And that's down in these explanatory sections of sections 9 through 17 generally. Okay, so here we have some of the explanatory material where before we see that the premise is that management acknowledges that he understands his responsibilities, and those were dictated above. This is typically done through an engagement letter or contract with management. But even though management has a responsibility for the preparation and fair presentation of financial statements, the auditor can still assist in preparing the financial statements in whole or in part based on information provided by management. But at the end of the day, management has full responsibility for preparing those financial statements. So that means that management needs to review and approve them, even if the auditor prepares them with the information provided to him. But also, we need to make note that preparing financial statements is not an audit procedure. It's actually a non-attest service that is discussed and performed in statements on standards and review of accounting and review services, so SARS. And so there may be a number of ways that the responsibilities for the entity are divided among themselves as far as the responsibility for financial reporting or for internal controls. And depending on the size and complexity of the entity, some things management might be responsible for and some things those charged with governance might be in charge of. But generally, management will be in charge of executing various things, and those charged with governance provide more of an oversight or review capacity. And in even larger companies or more complex companies, subgroups of those charged with governance, for example, an audit committee, might be the ones responsible for the financial statements or oversight of the audit. And so toward the end of the audit, the auditor is required to obtain written representations from management that it fulfilled its responsibilities according to the premise. So the fair presentation of the financial statements and the internal controls. And these written representations may be other things to support audit evidence throughout the financial statements or specific assertions. And so if management does not acknowledge its responsibilities through these written representations or in the engagement letter, then the auditor should consider not accepting the engagement. Because if he didn't get this premise, then he hasn't obtained sufficient appropriate audit evidence. So regarding the internal controls, management is responsible for the implementation, design, and maintenance of internal controls at the entity to prevent or correct material misstatements. But no matter how effective those internal controls are, it doesn't mitigate all of the risk that the financial statements are misstated. So only reasonable assurance can be obtained because of the inherent limitations of internal control. And so for that reason, an audit under GAS should not be used as a substitute for having proper internal controls. And that's why the auditor is required to obtain the agreement of management that it acknowledges and understands those responsibilities for designing, implementing, and maintaining the internal control. And the purpose of this audit is not to say whether or not the internal controls are appropriate. It's just management should be responsible for those internal controls to help prevent material misstatements. And so internal controls can be a lot of different procedures and processes, and no two companies are the same. So management needs to understand the risks and costs within its company and implementing various internal controls. And implementing these internal controls doesn't mean management has to have overly complex controls that aren't a good cost-benefit relationship with the risk it has within its company. So if a company is fairly small and not very complex, less internal controls may be appropriate in the circumstances and may be more regarded where levels of management or the owner operator performs a pretty detailed review function rather than hiring a whole slew of staff accountants to make an appropriate internal control environment that would be more appropriate for a larger entity.